Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, investors and podcast listeners, to episode 39 of the Absolute Return Podcast. I'm your host, Julian Klimachko.
And I'm Mike Kesslering.
Today is a chilly Monday, November 11th, 2019. Have a number of important market events to chat about on this week's podcast. Off the top, we're going to chat about CPPIB, that's the Canada Pension Plan. They acquired one of Canada's biggest wind power producers for $2.6 billion. What's the strategic rationale behind this? Another private equity or pension fund infrastructure deal. We're going to talk about Walgreens. They're considering going private in the largest leverage buyout of all time. What are the chances of it happening? In IPO land, GFL Environmentals, which was supposed to be Canada's biggest IPO in a very long time, it actually flopped. Why did they end up pulling the deal? Also, in international IPO news, Saudi Aramco, they launched their much anticipated IPO that could value the company at up to $2 trillion, which would be the largest company in the world. Should investors buy this stock? And lastly, we'll have a quick overview of October factor performance. Interesting infrastructure deal this week as the Canada Pension Plan Investment Board announced the acquisition of wind power producer Pattern Energy Group for $6.1 billion US. This is inclusive of debt, so on a market cap basis, equity of $2.6 billion. This is a friendly deal struck at $26.75 cash per share. This represented a premium of about 15%, which is on the skimpier side. We typically see control premiums on a takeover at around 25%. So 15%, not too great of a price. However, this asset was pretty widely shopped in the market. Their strategic alternatives process was well known in the media, pretty well publicized. But this deal, it reflects Canada's largest pension funds increasing demand for both renewable power and stable infrastructure assets. Now, this is really shown in the valuation of the deal. CPP paying 14.4 times next year's EBITDA, which is a fairly steep price, but that just shows how much in demand these type of assets are, these stable cash flowing infrastructure assets in the eyes of institutional investors such as pension funds like CPP. Now, what Pattern Energy Group does, they're an independent power producer with a portfolio of 28 renewable energy projects. They have an operating capacity of about 4.4 gigawatts in the US, Canada, and Japan. And some background on CPP, they're a $400 billion pension funds, one of the largest in the world, one of the most sophisticated investors in the world as well. Their goal is to pay the benefits owed to workers in the and Canadians in the Canada Pension Plan, which is they actually created a standalone group to hold power and renewable assets just a couple years ago. So this is a continuation of that trend. They've already invested more than $2.1 billion in renewable energy projects since that creation of that group, and they really see a disconnect between private market value of those and public market interest in those renewable energy stocks. Nonetheless, like I said, this offer 15% premium, so not a knockout bid by any means, but this was a well-shopped asset, shopped on a public basis. So what's interesting is that, number one, the stock was trading at $27.80 prior to this deal being announced at $26.75. So obviously the market and pre-arbitrage speculators, which we discussed on last week's episode, they were expecting a much higher premium on this deal. So unfortunately for them, this pre-arb trade did not work out. They're getting less than expected. So that premium is based on the unaffected price prior to announcing this sale process, and the $26.75 takeover price is actually a pretty substantial discount to what the market was expecting, as it was trading quite a bit higher than the ultimate price. Nonetheless, CPPIB in the merger agreement, they're actually allowing Pattern Energy to shop itself. They have a so-called go shop provision, which allows Pattern Energy to go to other buyers until December 8th to seek a higher bid, which is really unusual in this context, isn't it?
Yeah, absolutely. And, this may have been part of their strategy to perhaps pay a bit less of a premium, judging by the quotes from CPPIB, as they do. They won't comment on any other potential bidders joining the fray, but, their comments of that they do believe they provided the adequate value to Pattern shareholders. Speaking of Pattern shareholders, the shares have underperformed competitors such as Brookfield Renewable Partners and some others over the last 5 years. So there is likely some frustration amongst shareholders there. So CPPIB looking to take advantage of that. In terms of other companies that may be interested, is Brookfield Renewable's parent company, Brookfield Asset Management. It was reported that there's likely some interest from them, but as you had mentioned, Julian, they have already had an extensive bidding process. So if Brookfield was interested, they likely would have already put in a bid. But one thing that you mentioned with regards to the pre-arbs is, that they didn't do very well on this. They, depending on when they did invest, they might have lost some money on this pre-arb speculation. So it really does just highlight some of the riskiness that when we did discuss pre-arbitrage and those situations, we did mention the risk, and this is a classic example of the risk, is there's always an amount of deal speculation, but sometimes it really doesn't pay off to get involved in those situations. And one other aspect, just in terms of the strategic rationale from CPPIB moving forward, taking them private, is as a private company, it is believed that they may be able to increase their leverage profile. And with very stable assets such as these that are quite leveraged, it is one of the main mechanisms to increase your return on equity as the sponsor.
Interesting. I just wanted to comment on the trading. Now, this offer price is at $26.75, and the stock's trading at $27.50, which on first glance appears to be at a premium to the takeover price, but it in fact is not, because you need to look at the total return, which is inclusive of dividends. Pattern has a relatively high dividend yield, roughly 6%. So if you include all those dividends up to your estimated close, it's actually trading at a discount to the consideration, roughly 2.3% annualized, which isn't really pricing in a bidding war, really not pricing in much upside beyond the current deal. However, it's pricing in a relatively low risk deal, and I would certainly consider this a low risk deal. Obviously, no real competition, regulatory concerns, and CPP is obviously a buyer of the highest quality. Doesn't really get more high quality than the $400 billion pension fund behemoth in their wheelhouse of acquiring infrastructure assets. So for risk arbs, fairly safe deal, 2.3% annualized return that you can really bank on as a merger arbitrage. A fascinating story in the leveraged buyout space, with Dow Jones Industrial Average constituent Walgreens Boots Alliance has been in discussions to go private in what could be the largest leveraged buyout in history. Some background on the company: Walgreens Boots is the largest retail pharmacy in the US and Europe, with nearly 20,000 stores in 11 countries. It operates Walgreens and Duane Reade stores in the US and Boots outlets in Europe and Asia. 3/4 of its revenue comes from their US pharmacy business. Now, this pharmacy behemoth, they're one of the largest out there. They've been in discussions with several private equity firms, and this was reported in the media last week, for an LBO valued well over $70 billion, which is just massive in size. To give you some context with respect to the size of the bid, this would be by far the largest LBO in history. The previous largest, or the current largest LBO in history, I should say, was the 2007 sale of utility TXU Corp to KKR and TPG, which was worth about $45 billion, which also ended in disaster. It ended up going bankrupt, and LBO shops lost their shirt on that one. So certainly a pretty ominous sign, competing for that title of largest leverage buyout in history. The other really interesting aspect of this deal which investors should really take into account, is this would be the second time that Walgreens has been taken private. The last time being, again, in 2007, they were LBO'd by KKR, and you notice that name coming up a lot. And ironically, KKR this time has approached Walgreens for a second LBO on the same company, which you don't see all that often, but it is quite interesting nonetheless. But in my opinion, you have two real ominous signs with this proposed LBO of Walgreens. Number one, the largest LBO of all time. If you look at the current record holder, TXU in 2007, number one, not only was that a massive disaster in that it ended up in tears for the private equity firms backing the deal, but also it marked the previous cycle peak for the last business cycle right before the world spiraled into the Great Recession, 2008, 2009. The other aspect investors should take into account is back when Walgreens did their first LBO, that was also in 2007, also peak of the cycle. So you take that analogy and look at it this time, you got to wonder, is that marking the peak of the current business cycle? What are your thoughts on it?
Yeah, it certainly is an interesting aspect. And one aspect that I did want to point out was the initial merger, as you had mentioned, between Alliance Boots and Walgreens back in 2007. Now, this was kind of a exit for KKR at the time where Walgreens acquired them. And this was obviously viewed as very favorable for KKR, as instead they had kind of had a couple options to exit their position. That's either do a secondary offering where you would have to market your shares at a discount to that current price, or find an acquirer and get acquired at a premium to the price. So that's kind of a little background of why a private equity backer would really look for a strategic acquirer, as opposed to, the secondary issue is kind of their last resort.
Yeah, it's an interesting comment on the structure of leveraged buyout funds, because they have a fixed term, typically 7 years, so they'll buy a company and look to flip it within that 7 years. But now what's happening, instead of owning Walgreens the entire time, KKR raised a fund, bought it, flipped it, exited, then raise another fund looking to buy it again, which is just, you look at that and all the inefficiencies that involves, but nonetheless, a significant number of fees for the LBO sponsor, of course.
Absolutely. And you did mention, raising another fund. So Bloomberg actually reported that KKR's America's 7 fund has about $8.25 billion of dry powder currently. So if you, with the current trading of Walgreens, if you assume a 10% premium to buyout shareholders, and equity making up about 40% of the funding as they are leveraged buyouts, then a PE consortium, as it's been reported that this would likely have to be a club deal. It wouldn't be able to just be KKR.
Oh, it would certainly have to be. I think the largest LBO fund of all time might have been Apollo or Blackstone at $20 billion.
Yes, and so in terms of the equity portion that they would need for this transaction would be over $30 billion. So, KKR doesn't have that in their America's 7 fund. And then beyond that, they would have to raise another, $40-ish billion in debt financing. So really, this would be something that would be very large just in terms of the scope of including some of these large players on the private equity side, but as well as the leveraged loan market, which would be very interesting to see what demand there would be for a loan such as this.
Right, not just leveraged loans, but junk bonds as well. And there's two interesting dynamics there. Number one is on the debt side, $40-50 billion. We have seen quite a few number of deals like that. I remember a big one was the Verizon acquisition of Vodafone's interest in their U.S. business, which was a massive debt deal, which went pretty much without a hitch. And I think if this deal were to happen, that the debt side would be the very, very easy side because interest rates are so low. There's just so much demand with anything with a hint of yield on it. I think these loans and bonds, of which there'd be many, would be structured, into many different slices. I think that would sell quite easily. However, you mentioned this large equity check, which would pretty much need to involve at least a half dozen LBO shops, it appears, just to come up with that size of equity check. I think that will be much more challenged to get that many private equity firms on side, and club deals used to be very popular last cycle, but a lot of firms soured on that type of structure. So we'll see if that sort of structure reemerges. I wanted to touch on the strategic rationale. Now, the CEO of Walgreens has a 16% stake, and he's pretty frustrated with the share price. It's lost 28% of its value over the past year. Which is pretty bad when S&P 500's been doing nothing but going up. So life as a public company has been pretty traumatic for them. Walgreens shares have fallen pretty precipitously. They're racing to cut staff, close stores. They have this big cost-cutting program, which perhaps they perceive as public markets not really being too friendly with that restructuring. So this buyout would give Walgreens time to adapt to a fast-changing retail landscape, free apparently from the quarter-to-quarter demands of public shareholders. That's what the company's claiming, but I mean, what private equity firm doesn't care about quarterly performance, right? So you got to look at the market action here. Stock up about 10% over the past week as the market prices the chance of success of this happening into the market, as do the bonds. Bonds trading down 2.5%. So obviously this deal would be negative on the bonds as they would load the company with debt. As for chances of this happening, I mean, it's definitely less than 50% in my opinion. Massive challenges just coming up with the financing here. Obviously, valuations are quite high, but nonetheless, you look on the other side of the coin, private equity firms have record amount of dry powder, which they need to put to work, and ultimately putting that money to work means more fees for the private equity firms, so they are certainly incented to get a big deal like this done.
Absolutely. And so just in terms of some of that incentive as well, is that the company has actually been returning capital to shareholders over the last couple of years at a pretty high rate. So it currently has a 2.9% dividend yield, and they bought back shares, about 7% of shares last year. So our preferred metric, the shareholder yield, at about 10%. Now, that could likely be allocated, a vast majority of that could be allocated to debt pay down in an LBO situation. So that gives a little bit of insight into the favorability that would be looked upon by KKR to this business model, even though it hasn't been growing. Their EPS really hasn't been growing. One last thing I did want to mention was that Berkshire Hathaway was mentioned by Barron's as another possible suitor in this situation, although it must be noted that Berkshire doesn't typically participate in auctions, and so it does appear that this deal is being shopped around, and so likely would result in Warren Buffett and Berkshire not being interested in it.
Some interesting IPO news and continuing trend of IPO flops. This time it was GFL Environmental. So this was supposed to be one of the largest Canadian IPOs in many years, but it failed to generate sufficient interest and was ultimately pulled. Yeah, this deal flopped, and what happened was investors balked at the valuation. GFL came out at a marketing range of $20 to $24 per share. And they have a pretty significant debt level. And with that level of risk, investors really had no interest at that price. I did hear that there was some interest, could have maybe gotten done at $18 a share. But ultimately, the sponsors and the company chose to withdraw the deal and maybe come back to the market at a later date instead of taking that lower valuation that what they wanted. Now, what GFL does, they're an Ontario-based waste hauler, and they have, as I said, a massive amount of debt. They're pursuing this consolidation strategy, this roll-up strategy, and from that, they have accumulated $6.5 billion of debt. Not just that, but they have yet to be profitable. Over the past 3 fiscal years, they've lost a cumulative $737 million. The first 6 months of 2019, they lost $161 million. So unprofitable, highly leveraged company. Where have we seen this before? And one example of an IPO flop was Endeavor, the owner of the UFC. That was a leveraged buyout. Investors balked at that deal based on debt concerns and valuation. So that deal ended up getting pulled. Another one, which we've discussed ad nauseum, was WeWork, not necessarily on the debt side, but it was a valuation issue in addition to corporate governance. Nonetheless, this GFL deal was expected to raise as much as $2.4 billion. That's in US dollars. So if we compare that to other landmark deals in Canadian history, there's only a few comparable. Ottawa's sale of Canadian National Railway in 1995, that netted $2.2 billion. Manulife Financial's first public offering in 1999, which raised $2.5 billion. So this really ranks up there with some of the largest IPOs in Canadian history. And then you look, this was supposed to be an exit for the private equity backers, which include BC Partners and Ontario Teachers Pension Plan. But it just shows you the strength of the private markets. There's just so much capital there that companies don't need to rush to go public anymore, because they now have the luxury of deferring an IPO, hit up their sponsors for more private equity, and just stay on the private side and not worry about it. Try to hit the market when there's better market conditions. But I mean, can market conditions get any better than as they are right now?
Absolutely, and I mean, as you'd mentioned, you know, an IPO or an acquisition is just one of the exit strategy, or a couple of the exit strategies used by private equity. So really, this is another example, and I believe when BC Partners and Ontario Teachers had acquired their stake in GFL, they had bought the company, I believe this was in 2018, from HPS Investment Partners, Macquarie, and Hawthorne Equity. And so really the exit now has been to exit to another private equity firm. So that really isn't a sustainable exit strategy. So it will be interesting to see how this will end up, you know, some of the deployment of private equity capital initially into these transactions as some of these well-worn IPO acquisition exit strategies become less available. So that'll be something really interesting to follow here.
Right, and with those continuous exits to other private equity shops, which we refer to as LBO hot potato, it's really a game of musical chairs. You can only really play that song and dance a limited number of times, because you can only leverage buyout a company so many times. And the other potential exit strategy is always to a strategic acquirer, but on GFL, I'm not sure if there'd be any strategic appetite on a highly leveraged company like this one. So I think public markets is probably ultimately their best source of exit. Ultimately, the sellers here, it appears that they're kind of getting a bit greedy. Nonetheless, have a quote from the CEO, Patrick DeVigi here. He stated that the existing shareholders have determined that at US $18 per share, we don't believe that represents fair value for the company, so the shareholders have decided to inject more equity into the business to fund the future growth of the company and revisit the public markets at a later date. So there you have it, GFL pulling their IPO for now, perhaps revisiting it at a later date, but it'll to be seen if market conditions are any more favorable at that point. In an IPO that looks like it's about to go ahead, Saudi Arabia, their state-owned oil company, Saudi Aramco, they officially moved forward with their plans for an IPO. They filed their prospectus just a couple days ago on Saturday, 600 pagers, so a lot of information in there. Now, this IPO is expected to be the largest of all time of the whole world. Not just US, which has been home to some massive IPOs. I believe Alibaba might have been the largest at 20 billion. However, this one could be significantly more than that. They're estimating between 15 to 30 billion. Now, this would represent only 1 to 2% of the company, making it very, very unique, because this will be a very small portion of the company that they're seeking to IPO. Initially, the Crown Prince Mohammed bin Salman, aka MBS, he touted a valuation of $2 trillion for Saudi Aramco. Now you're hearing market analysts saying that it's just too high of a valuation, looking to be perhaps 1.2 to 1.5 trillion dollars. And where this valuation is coming from is based on dividend yield. So Aramco said it would pay out 75 billion in dividends next year. So at the valuation of 1.5 trillion, the company would be yielding a 5% dividend yield, which is comparable to Royal Dutch Shell at 6% and Chevron at around 4%. What are your thoughts on the valuation process behind this one?
Yeah, it really seems like they are pushing the valuation based on the dividend yield. So, very similar to just a preferred share offering or subordinated debt rather than equity. But as well as other valuation methods. Now, when the underlying assets of Aramco were nationalized in the 1970s, the owners, which are now Exxon and Chevron, were compensated at book value.
Forced sellers.
Yes, they were very much forced sellers. So, you're never going to get a fair price in that sort of situation. But if the market were to value Aramco on this basis, it would actually be only valued at about 380 billion. But, when looking at an energy company, book value really isn't the proper metric to be valuing them at, as it is a cash flow generating company, so it makes more sense to be valuing it on a cash flow multiple. But I did think that was very interesting, just in terms of the different valuation tools used between then and now. But looking at the offering, and this is, I believe the first time this was announced was in 2016,
right,
when
yeah.
MBS had originally brought up, floating some of the company.
Right, over 3 years ago.
Yes, and there's been plenty of different, detours from this, as, now it looks like it will only be a listing in Riyadh, no longer looking at a co-listing in London or New York or anything like that at this current iteration of the plan. But, when looking at it as an investor, being a minority shareholder and with the disclosure concerns that you do have with a government entity, which, Saudi Aramco really is, it really makes this equity a risky proposition, despite its large size, because, it's being marketed as a dividend yield, but, that a dividend can be cut, it can be changed at any point in time, and it can also be increased, but it can be changed at any point in time. So you really aren't protected on the downside here, despite this being a very, very large cap name.
Right, and so it's a real tricky one here to justify buying. Not only do you basically have no rights, because the Saudi Arabian government will control this. They're only selling 1% to 2%. So obviously shareholders pretty much have zero say, no rights. And you got to be concerned on the corporate governance with respect to a state-owned entity. That's always an issue, more so even here, just given the geographic nature of this and some of the history behind that. The other thing you got to consider, as you mentioned, it's only trading on the Saudi Arabian exchange, which limits retail participation. I believe you need to be a mutual fund of at least $500 million in assets in order to trade on there. So retail investors can't really get access to it outside of a fund structure. But nonetheless, at the valuation with corporate governance issues and the lack of shareholder rights, this is a pretty easy one to pass on, especially since it's so difficult to trade for investors. And lastly, I wanted to touch on October monthly factor performance. First off, in the US, you had the multi-factor model down a couple percent, and that was largely driven by negative factor performance at Equality and operating momentum. Largely on the short side, you had a big rally in the low quality names and also on stocks whose price momentum was poor over the past 12 months. They had a bit of a dead cat bounce in October. On the positive returning side, value continues to do well, up 3.5% on a long-only basis in the US, and then overvalued names actually dropped 2.5%, adding to the US long-short value outperformance. But you add up all of our factors, and that ended up in a negative 2% long-short multi-factor return. However, in Canada, you got a different story. Actually, it's 7.5% of alpha from the long-short multi-factor portfolio, and that was driven by two factors largely. You had very good value performance, but what's interesting about value long short is that on the long side, it actually dropped about 0.5%, where all of the value performance and more came from was on the short side. So stocks with negative EBITDA, stocks with negative free cash flow, that's how we view kind of the worst value stocks. They actually dropped 12%, giving a lot of positive performance to the short side of that trade. The other thing on the trend side, so your long trend portfolio up over 5%, your short trend portfolio down over 4%. So you had positive performance there. You combine those two factors along with the other ones, results in net alpha for 7.5% for the multi-factor long-short portfolio. So in summary, good performance out of Canada, poor performance out of the US, but value continues to outperform.
And what this really highlights is something that we've mentioned before, the differences between factor investing and smart beta, is it really highlights the importance when you're trying to extract alpha out of these factors that we've identified, is investing on the short side as well to capture that full factor premium.
Not just that, but it provides the benefit of diversification, so you can capitalize on generating returns from market drawdowns or just poor performance of those stocks that we expect to not do so well. And that's it for us, episode 39 of the Absolute Return Podcast. As always, if you enjoyed it, you can check out more at absolutereturnpodcast.com. Feel free to recommend it to your friends, coworkers, family. Leave us a review if you'd like. Until next week, we will chat with you soon. Cheers.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.